My name's Richard Crosby. I'm a corporate partner in the financial institutions team here at Clifford Chance, and I'm delighted to be joined today by Caroline Dawson, who is a partner in our regulatory team. And the theme of this session is M&A in the FIG sector, why 2025 was such a busy year and whether we think that's going to continue through to 2026. And what Caroline is going to be enlightening us on today is the role of regulation and regulators in M&A and whether or not they are going to either help or hinder it. So Caroline, 2025 was a bumper year for M&A. And the question for you is, to what extent do you think regulators or regulatory developments were behind some of that increase? Or was it more a case of just regulators being a bit more receptive to deals? What do you think?
So I think actually, although maybe there wasn't necessarily a direct regulatory driver, I think what we did see a lot of was consolidation at the sort of smaller end of the market. So we saw a lot of consolidation in, for example, motor finance across Europe. We've seen consolidation in consumer credit, in asset management. And I think all of these are areas where economies of scale are really important. And regulation can have a huge impact on the viability of some of those smaller businesses. So if you look at probably maybe the three largest drivers of costs for some of those smaller businesses recently have been conduct and compliance. So again, particularly in the motor finance space. I think technology is another big driver. So where you see this drive to digitalization, you see people operating through platforms. You're not just as a tiny bit part player going to be able to immediately run a platform that's as attractive to your core client base as some of the larger players. So again, that creates a clear incentive for consolidation. And then resilience. I think the regulatory focus on resilience and, how robust your business is, how diversified you are, and all of those things, again, are going to play towards consolidation.
One of the things we've been talking about for a while now, Caroline, is the need for cross-border consolidation in the EU, particularly in the bank sector. And it hasn't happened mainly because of the inconsistency with banking regulation and the lack of banking union. Do you see any reason why that might change over the coming years?
I think that's a really interesting question. So banking union, I think, is tremendously important. I think it's also tremendously controversial within the EU. But there's a definite push to get it completed. Whether it's actually going to result in major consolidation across the EU banking market, I think, is an open question. I think if you look at the existing market across the EU today, if you look at Germany, 50% of the EU's banks are currently in Germany. So all the banks across all of the rest of the EU, same again in Germany. And we're not seeing a massive amount of consolidation within Germany. So I think my question is, are you going to see anything different when you've got, even with banking union, is that really going to spark any major consolidation?
That's interesting. So clearly banking union, not imminent. What about other drivers from a regulatory side for M&A? We've heard talk about CRD6, Savings and Investment Union. Do you see any of those as being significant drivers this year?
So I think, again, both of those are really interesting. I think CRD6 is more driving group restructuring. So for people who've got an existing European presence, they're working out which bits of their non-EU book they're going to have to move into the EU. I don't think that's necessarily going to lead to, for example, non-core sell-offs. I think what it is potentially going to lead to is existing non-EU players who are looking for a footprint in the EU, thinking about how they want to create that footprint. And one way that you can create that footprint is by opening a bank in the EU, but clearly then you're starting right from scratch. You need to create your entity, all of your books and records, your procedures. It's a big lift. So one way that potentially people are looking at getting that footprint in the EU is through acquisitions. Maybe that's through something that's being sold off by someone else. Maybe it's through, consolidation of a smaller player. Maybe it's through opening a branch and then turning that into a European entity. But people are definitely exploring those sorts of sides to things. I think if we look at savings and investment union, I think, again, if we're putting that in my scales for things which are going to drive M&A and things which aren't, I think it's in there with banking union. I think it's a necessary development. I think it's important to building European capital markets. Whether it is going to drive significant M&A, I think is still an open question, and certainly it's not going to drive it over the course of 2026. This is a long, slow build. I think potentially savings and investment union. So part of the idea of this is that it's going to encourage European depositors to move from being depositors to being investors. So moving their money out of low yield deposit accounts into higher yielding investment accounts, hopefully in European equities, and driving the growth of the capital market that way. From an M&A perspective, clearly that's potentially going to be beneficial for asset managers. There's more potential business for them. It's maybe going to make the EU more attractive for external asset managers. It's potentially going to drive consolidation within the EU of existing asset managers. I think my big question is, if you've got 40% of EU household wealth currently held in deposits, is there a reason for that? And if there's a reason for that, that's not necessarily going to be changed by the creation of savings and investment union. So if you're holding those 40% of household assets in a deposit account because that's your rainy day fund, because that's your go-to quick access savings account, that's not something that people are necessarily going to move wholesale across into the investment market. So I think that one's still TBD.
I think the interesting thing to that is, we've seen with interest rates potentially coming down this year, we've seen banks looking to diversify their business away from pure interest rate bearing revenue to fee generating revenue. And so you could see a world in which if people are being encouraged to move from deposits to investments, that's just going to continue that trend of banks looking to buy wealth managers, asset managers. So if they're going to lose it on the deposit side, then they can get the fee generation on the asset management side.
I think that's absolutely right, but I think it's still a big if. Are they going to lose it on the deposit side?
Yeah. It's good to hear that I think regulators are adopting a relatively benign attitude to M&A. That's good. There are a number of individual regulatory developments that might facilitate M&A deals, but no overriding one single thing that's going to be driving it. And I don't think we're likely to see any big regulatory facilitator of significant cross-border M&A in the form of banking union anytime soon. But I think it is a good regulatory environment, so it should be a good year for M&A in 2026.